The topic of today's lecture is financial statements with adjustments. Now, what are adjustments? Once we have prepared the trial balance, and before preparing profit and loss account and balance sheet, we need to make certain adjustments. And mainly, what are the adjustments? First of all, at the end of the year, you do the stock taking and bring into books your closing stock. Okay, now this is one entry. Second is certain expenses you have made, but you might not have made payment for that. For example, you might not have paid salaries for, say, the last month, that is March, and maybe you have not paid interest, like this. So there could be certain items on which you have to create outstanding liabilities. That means you have made the expense but not paid it. Similarly, certain expenses which you have incurred might actually relate to next year, next accounting period. For example, you have taken insurance and a part of it belongs to next year. So you have to bring this into books, because what belongs to next year should not belong to this year. So you have to make an adjustment for that. Similarly, on the income side, there could be certain incomes which have accrued to you but you have not received. Could be interest, commission, rent, anything. It has accrued to you, it has become due to you, but you have not received it. So you have to recognize that income in this year and create an asset which is to be, say, received maybe next year. Similarly, there could be an income which you have received this year but actually does not belong to this year. This belongs to maybe next year. This is earned income for you for this year, so it should be accounted for. It should be removed from the income of this year and should be put as a liability. Since unless you earn it, it's a liability, you might have to repay it. So these are the main adjustments which you have to make. Now, with the help of an example, I will tell you how you make these adjustments. And let me tell you, you always make these adjustments with the help of journal entries. So whenever a journal entry is passed, some account is debited and another is credited. Hence, every adjustments make effects on two accounts. Okay, and one will definitely go to balance sheet and the other will go to trading profit and loss account. Okay, so it affects two accounts. I hope I am very clear, and let us now understand with the help of one example. Now this is the trial balance given to you as on 31/3/2010. Now these are the 6 adjustments given to you. First of all, stock on 31/3/10 was valued at rupees 20,000. So now you have to bring this into books. Now what entry you will pass? Entry to be passed is stock account, that is closing stock account debited to trading account. This is closing stock account debited to trading account, that is 20,000. Now you see, because of this entry, now closing stock account has come into existence, right? Now this will be shown in the trading account here because of posting of this. Okay, and now this closing stock of rupees 20,000 will also be shown in the balance sheet. Here it is, stock 20,000. Is this clear? Whatever entry, adjustment entry we make, it will have effect at two places, right? Let us now see what is our other adjustment. Outstanding salaries rupees 5,000. What does it mean? It means we have not paid salaries amounting to 5,000 for the current year. Naturally, it's an expense. It should be booked to salaries account, and since we have not paid it, we must create a liability. So what should be the entry? Entry should be salaries account debit to outstanding salaries account 5,000. Okay. salaries account debited to outstanding salary 5,000. Now, what will be its effect? You see, this increases the amount of salaries in the profit and loss account. Here, salaries are in the trial balance 15,000. But while preparing profit and loss account, you see, we have taken salaries 15,000, and this salaries account has been debited. This has been added here, and net effect is we are debiting P&L with 20,000 rupees. And this new account which has come into existence, outstanding salaries for 5,000, this will be shown on the liability side of balance sheet. That is outstanding salary 5,000. Okay. Now, what is our third adjustment? Insurance was done on 1/10/2009. Actually, this firm's accounting period starts from 1st April to 31st March. So if you buy an insurance on 1/10/2009, that means whatever you have paid as insurance belongs 6 months to this accounting period and 6 months to the next accounting period. So what belongs to the next period is basically prepaid expense. It's an asset for you. So similarly, you should reduce your expenses which you have incurred this year by say half the amount you have spent on insurance. How much? 6,000. That means 3,000 belongs to next year. And what shall be the entry for that? Naturally, prepaid insurance is an asset. It shall be debited. So, prepaid insurance account debited 3,000 to insurance account 3,000. Now, because of this, what will happen? This new account has come into books, prepaid insurance 3,000, and it is shown on the asset side of balance sheet here, prepaid insurance 3,000, right? And insurance in trial balance is 6,000, and while we prepare this thing, profit and loss account, from the amount 6,000, we reduce prepaid, that is what we have paid for the next year, and the net amount taken is 3,000. Okay? Now, next is rent receivable for 2 months, rupees 2,000. That means we have to receive rupees 2,000 as rent from our tenants. It has not been received. It means it is our accrued income. We must take into this year, and we must create an asset called accrued interest. So entry for this will be accrued interest account debited to, accrued, not interest, accrued rent. Accrued rent account debited to rent account, 2,000 rupees. This means what? We are increasing our income on account of rent by 2,000 and creating an asset, accrued rent of 2,000 rupees. And if you look at this accrued rent, this is being shown in the balance sheet here. Rent accrued 2,000, it is an asset, right? And our income in the rent has increased by 2,000. In the trial balance, rent received was 10,000. It has increased by 2,000 because of this adjustment. And in the last, fifth adjustment is commission received in advance, 5,000. That means whatever commission we have received 20,000 as commission in this year. Out of this, 5,000 belongs to next year. This has been received by in advance. Naturally, we have to show commission at 15,000 and commission received in advance is a liability. So it will be recorded as a liability. So what shall be our entry for this? Entry for this should be, see, commission is to be reduced, so it shall be debited. Commission account debited to commission received in advance. That is how much? 5,000. Now with this, our commission account has been, because commission is a credit balance. It was an income. So when incomes reduced, they are debited. So that's why commission account has been debited here. And commission received in advance, it's a liability. When liabilities increase, they are credited. Hence it has been credited. Now income received in advance is a liability. And you see it is shown here. Commission received in advance, 5,000 rupees. Okay. And while preparing profit and loss account, this commission, which was 20,000 here, has been reduced by 5,000, and net amount 15,000 is taken in the profit and loss account. I think it is clear. Okay. Last is provide depreciation at the rate of 10% per annum on machinery. In our trial balance, machinery is at 4 lakh. So 10% of this will be 40,000. And what is the entry for that? Normal entry. That is depreciation account debit to machinery, 40,000. Okay. And because we have charged depreciation 40,000 in our trial balance, depreciation is shown at 40,000. And in the balance sheet, on the asset side, machinery is shown at 4 lakhs. And from this depreciation for the year, 40,000 has been reduced, and machinery is shown at net value, that is rupees 3,60,000. So this is the way all adjustments are made. Now there are certain more adjustments to be made, and I will be explaining you later that. But one point I would like to tell, that certain mistakes are committed during the preparation of our accounts. Even they are given during this time, that is at the end of the year, along with these kind of adjustments. So we have to put rectifying entry at that time also. I will give you an example. For example, they may say purchases include an amount of rupees 50,000 paid for buying a machinery. Now what you shall do for this? Naturally you shall pass a rectifying entry for this, and it shall be machinery account debited to purchases. And because of this, in trading account, purchases will reduce by 50,000, and machinery will be added by 50,000. Machinery account will become 4,50,000. And second thing you must keep into mind is that since machinery is increasing, it has increased from 4 lakh to 450. Depreciation you must charge at the increased amount, that is on the rupees 4,50,000. Okay. Another adjustment or rectifying entry could be, they may say wages include rupees 10,000 paid for the installation of machinery. Now amount paid for the installation of machinery is a capital expenditure and should have been debited to machinery account. So what shall be the rectifying entry for this? Machinery account debited to wages account, 10,000. Now with this, in the trading account, wages will be shown at rupees 20,000. You will reduce from here. Less paid for installation of machinery, 10,000, and net 20,000 will be shown here. And that 10,000 will be added to machinery. This 4 lakh amount will, to this 4 lakh, 10,000 more will be added. So now, for example, in this case, it will become 460. Now you must remember that you must charge depreciation on the increased amount, that is 4,60,000. 4 lakh original amount, 50 from purchases, 10 from wages. So depreciation you must charge on 4,60,000. Okay, now I will tell you, if whatever adjustments are given to you, if entries, if after passing these entries, again a trial balance is made and it is provided to you, how to prepare trading profit and loss account and balance sheet from that, I will tell you now. If you are provided a trial balance after making all the adjustments, like this is the old trial balance with us and all the journal entries we passed in the last example, after that our trial balance will appear like this. Okay, now how to prepare trading profit and loss account and balance sheet from this, I will explain it to you. There is only one difference I would definitely like to explain you, that is regarding purchases, opening stock and closing stock. You know, in this case, you see purchases appear at 354, not at 350. You know how it has happened? Actually, this opening stock has been added to purchases by putting this entry. Purchases account debit to opening stock 24,000. With this posting, it has become 3,74,000. Now to bring closing stock in books, we have made the entry closing stock account debit to purchases, and here comes the closing stock in purchases account, and 354, which is the balancing amount here, is transferred by closing entry to trading account, that is here. So this is all about purchases. So if in a given trial balance you are given purchases and closing stock, and in the adjustment no closing stock is told to you, that means that purchases have been adjusted with opening as well as closing stock. Okay, then purchases should go to trading account and closing stock will not appear in the trading account. It will not appear here, it will appear only at one place, that is in the balance sheet, like here, stock 20,000. Is it clear? All other items which appear in our new trial balance, they are all after we have prepared those journal entries, adjusting journal entries. Now all these items will go only to one place, either trading profit and loss account or balance sheet. Let us see. This has been explained to you. Wages 30,000, salaries 20,000, right, and insurance 3,000, depreciation 40,000. Okay, then here is rent. This is after adjustment. Do you remember earlier it was 10,000 and 2,000 was receivable, so after adding that it came to 12,000, and this is being shown here. Similarly, commission also is after adjustment. This is being shown here. That is it. That means whenever all these entries like outstanding salary, commission received in advance, and all these appear in the, or prepaid insurance, if they all appear in the trial balance, you need not make adjustment entries. It means adjustment entries have already been made. Okay, and all these items will go only to one place, like in the balance sheet. You see, all other items have been taken like that in the similar manner. Like rent accrued is here 2,000, prepaid insurance 3,000, stock as usual 20,000, and you see machinery is at 360. That means what? Machinery is 360 because the adjustment and entry of depreciation has been put, and depreciation appears in the trial balance, right? That's why from this is taken here as 40,000, but it has not been reduced. 360 has not been reduced further by 40,000. So this is actually the net figure of machinery 360. That is after reduction of depreciation. That's why machinery is shown at 360. I hope it is quite clear. I will repeat it, that if you see in your trial balance prepaid expenses, incomes received in advance, like these kind of things, that means entries for them have been made and you need not do anything further, and anything appearing in the trial balance will go only to one place, that is either trading and profit and loss account or balance sheet. Is it clear? Okay, now I will tell you about other adjusting entries to be made, like to make provision for doubtful debtors, etc. The next adjustment relates to bad debts. Now, what are bad debts? These are the amounts which could not be recovered from our debtors, irrecoverable amounts. So they are to be written off. So for that we pass the entry bad debts account debit to sundry debtors. With this, a new account comes into existence, that is bad debts. Okay, let us see. In the trial balance, debtors are given at 1 lakh and bad debts are given at 2000. What does it mean? It means that a journal entry bad debts to sundry debtors has been passed for 2000 rupees. That's why they appear in the trial balance. That means before passing this entry, sundry debtors were worth 1,02,000. Okay. Now in this case, adjustment is given that further bad debts are 3,000 rupees. That means after the preparation of the trial balance, you come to know of further 3,000 bad debts, and you have to take this also into account. So another entry you will pass for this bad debt account debit to sundry debtors for 3,000. Okay. Now how you will show this in profit and loss account? In the profit and loss account, you will show bad debts 2,000, which were in the trial balance, and these are actually the bad debts given in the adjustments are called further bad debts, and further bad debts will be added to the earlier bad debts, and total will become 5,000. And in the balance sheet, this will be shown at 1 lakh figure, that is in the trial balance, and from this further bad debts will be reduced and net figure of 97,000 will be shown in the final column of balance sheet. Now you must be wondering why we have not reduced total of bad debts 5,000 from this amount. For the simple reason that already 2,000 has been adjusted from the sundry debtors. That's why they appeared in the trial balance. We will adjust in the balance sheet only the amount of further bad debts. Is this clear? Now we will deal with provision for bad debts is actually created to safeguard the interests of the business. In the sense, whatever sales we have made during this year, some of the bad debts may incur next year. So the next year's profit and loss account may not be burdened with this year's bad debts. For this reason, we create a provision for bad debts during the current year. Okay, and the entry for that is profit and loss account debit to provision for bad debts. So once you pass this entry, your profit and loss account will be debited with 4,850. Actually, here you are given that create a provision of 5% of debtors. Right? Now, which debtors? Which amount of debtors? Debtors are 97,000. That is after deduction of all the bad debts. Final debtors are 97,000. 5% of that we have created provision. So the amount of provision will be debited to profit and loss account, and it will be shown as a deduction from the amount of sundry debtors in the balance sheet. Now you see, this amount of 4,850 in the provision for bad debts will be carried forward to next year, and in the trial balance of next year it will be shown as a credit balance. Right? Let us see how it happens. Let it be the trial balance of 2010. Okay, so provision for bad debts 4850. This will be shown as opening balance there. And let us assume the figures of 2010 to be 1,50,000 and 4,000. Okay, and again this year the requirement is that create a provision for bad debts at 5% of debtors. So that means this year also we have to create provision at the rate of 5%. On which debtors? That is the amount of debtors we have here, 1,50,000. So 5% of 1,50,000 will be how much? It will be 7,500. So 7,500 is the provision required for next year. But these amount of bad debts will not be transferred to profit and loss account this year. Rather, they will be written off to provision for bad debt account, 4,850. I will show you the account of provision for bad debts. Provision for bad debts. This is for 2010. So this is the opening balance, 4850. And this amount of bad debts which are appearing in the trial balance will be shifted to provision for bad debt. Entry for that will be provision for bad debt account debit to bad debts. So to bad debts, 4,000. And for the next year, you require a provision of 7,500, which you will take from profit and loss account. But 7,500 that one, and here the difference is, you had a credit balance of 4,850, but you debited only 4,000. That means rupees 8,500 is still left from the last year's balance. So 7,500 is required for next year. From this we will deduct 850 which is still left from the last year's balance. So 6650 is the amount which we will take from 2010's profit and loss account. The entry for will be profit and loss account debit to provision for bad debts. So by P&L account 6650. Okay. This will be the amount, that is the 7,500, which will be carried forward to the next year. And the profit and loss account of 2010 will be debited by only the amount of provision we created this year. Provision for bad debts. How much? 6650. Net figure. This is the figure. The other way of presenting this thing is that you show the whole, actually this thing there. So it will be shown like this. Bad debts 4,000, add new provision is 7,500 less old provision. How much is our old provision? 4,850. And the net figure we will show in the outer column will be 6650. This is the way we present our provision for bad debts. Now in the balance sheet of 2010, how we will show this? This year our debtors are 1,50,000 and thereafter deduction of 4,000 as bad debts, and they have been written off here. So here sundry debtors will be 1,50,000 less provision for bad debts. Provision for bad debts. How much is the provision made this year? 7,500. This will be carried forward to the next year. So 7,500 will be deducted from this, and it will be, the net figure will be shown there, that is 1,42,500. For example, if there were any further bad debts in this, if it was given in the question, then from 150 we would have deducted further bad debts. Okay? Or they would have also been debited to this account. Sometimes it may happen that after you have made provision for next year, like we have made a provision of 7,500 next year. For example, if the brought forward balance was 14,850, okay, and bad debts were only this much, and balance carried forward or amount required for next year was 7,500. That means we would have been left with excess balance even out of the last year's balance. Then the difference should have been credited to profit and loss account. How much you would have done it? 14,850. Okay, and let me show you. To P&L account, to balance carried forward 7,500. So this is 14,850. So out of 14,850, if you deduct 11,500, how much it will be? It will be 3,350. So this is the amount which will be credited to profit and loss account. This will be credited to profit and loss account. I hope it is quite clear. Similar to the provision for doubtful debts, we also create provision for discount on debtors. The logic is also the same. That means the debtors which we created this year because of this year's sales, if they avail of discount next year, so next year's profit and loss account should not be debited with those discounts. Actually those debtors belong to this year, right? So the discount availed by them should be debited in the current year's P&L account. For this purpose we create provision for discount on debtors. The entry for this is profit and loss account debit to provision for doubtful debts. Okay, and this is carried forward to the next year, similar to the provision for doubtful debts. And next year when discount is actually given to debtors, that is not debited to P&L account, rather that is debited to provision for discount on debtors. Okay, now one thing you must remember, that while creating provision for discount on debtors, on which amount it should be created, this should be noted very carefully. First of all, from the amount of debtors, you must reduce if there are any further bad debts. That means any bad debts given outside the trial balance, right? And if you need to create any provision for doubtful debts, that amount should also be reduced from debtors. Okay, then on this amount you need to create provision for discount on debtors. Reason is simple, that we need not create discount on debtors provision for this thing on those amounts which we are not supposed to get. I mean, which we are thinking that we may not get them. So there is no point in creating that. Okay, let us understand the whole thing with the help of this example. Like in the trial balance, you are given sundry debtors worth 1,06,000, and in adjustments you are told that bad debts are 6,000. You are told to create a provision for bad debts at the rate of 5% of debtors. Create a provision for discount on debtors at the rate of 2%. Now you see, in the profit and loss account, you will debit these bad debts 6,000, and on the balance amount, that is from 1,06,000, when 6,000 is reduced, on the reduced amount of 1 lakh, you will create a provision for doubtful debts at the rate of 5%. That is 5,000. That again will be debited to P&L account. Entry will be P&L account debit to provision for bad debts. Right? Now, from 1,06,000, when this 11,000, 6 plus 5 is reduced, on that reduced amount, you have to create a provision for discount on debtors at the rate of 2%, and that comes to 1,900. Again, entry is P&L account debit to provision for discount on debtors. So that's why this will be debited to P&L account. And in the balance sheet, this will be shown like this. This is the amount of sundry debtors appearing in the trial balance. And this is the amount of further bad debts which were given in the adjustments. Here, they are reduced. And from this, we created a provision for bad debts. This is also subtracted from this, and on 95,000 rupees, a provision for discount on debtors is created at the rate of 2% here, that is 1,900. That is also shown as a deduction from sundry debtors, and this final figure of 93,100 is shown in the balance sheet. Now we will discuss reserve for discount on credit. Now we will discuss reserve on discount on creditors. You know, if we have bought goods this year and created creditors, but at the end of this year they are still outstanding, that means we have not made payment to them. If we make payment to them next year, definitely we will be availing of discount next year. So some people feel that since these creditors belongs to current year, the credit or the discount you are going to receive next year basically belongs to this year. For this purpose, they take credit for discount on creditors in this year's profit and loss account. Though it is not right actually, because according to prudence principle, we should not take into books unrealized profits. But still, just for academic purposes, I am telling you what entries we make at this time. You know, if you want to create a reserve for discount on creditors, right? For example, if there are creditors worth 3 lakh in your books and you are asked to create a provision of 5% on them, then what will be your journal entry for this? It will be reserve for discount on creditors, that is 5% of 3 lakhs, 15,000, to profit and loss account, 15,000. This practically means that you have credited this year's profit and loss account with rupees 15,000. I mean, this is the assumed amount which you will receive next year's from creditors when you make payment to them. Okay? So in this year's profit and loss account, this will be shown on the credit side as an income. Okay? And in the balance sheet, it will be shown on the liability side as a deductions from creditors. Creditors will be shown at 3 lakhs, and from that reserve for discount on creditors 15,000 will be reduced, and net figure of 285 will be shown in the balance sheet. Now in the next year, when you actually receive these discounts, you won't credit them to next year's profit and loss account, rather you will be crediting them to the credit of reserve for discount on creditors. I think I am clear about it. Okay. Now we will discuss manager's commission. You know, in many times in the question it is provided that we have to provide for manager's commission. This is based on the profits earned by the firm. Now in this question, provide for manager's commission at the rate of 10% of net profits. Now the net profit could be of two types. One, net profit before providing for manager's commission, and then profit after providing for manager's commission. For example, in this case, gross profit is 2 lakhs and the expenses are 90,000. That means our net profit before providing for manager's commission is 1,10,000. Now, if the question says that you have to provide for manager's commission on this profit, that is before providing for manager's commission, that means we must pay this fellow 10% of rupees 1,10,000. Okay, so 11,000 will be payable to him, and we have to create a liability for this. So entry for this will be profit and loss account debited to provision for manager's commission 11,000, and this being an expense will be shown on the debit side of profit and loss account here, and again it being a liability, since we have not paid for it still, so it will be shown as a liability in the balance sheet. I hope it is quite clear. Now we will deal with the other aspect, that is, if they say that you have to pay for or you have to provide for manager's commission on net profits which are left after making provision for manager's commission. This simply means that after providing for manager's commission, right, the profit left should be basically, or you can put it in other words, that the commission given to manager should be 10% of the profits which are left after providing for that commission. In net, we can say that, for example, if our profits are rupees 1,10,000 before providing for manager's commission, as in this case, this means 10,000 should be given to manager, and now 1 lakh will be left for the firm net profit. Now this manager's commission 10,000 is 10% of rupees 1 lakh which is left after providing for commission. So that means whatever the net profit before providing for manager's commission should be divided into two parts. One part, 10 parts for manager and 100 parts for net profit. So that means for calculating manager's profit, we must multiply the profit before providing for manager's commission with 10 upon 110. 10 is the rate of commission, and 110 is basically means that we have to divide this into two parts, 10 and 100. Ratio is basically 10 is to 100. That's why we have multiplied this by 10 upon 110. If you notice, in this way, the commission payable will be 10,000. Okay, and if we put it 10,000 here, then net profit will become how much? It will become 1 lakh, right? So here the change will be, it will become 1 lakh. Now you see, this commission is 10% of this 1 lakh which is left after providing for commission. Is this clear? And now this will be shown at 10,000 in the balance sheet. I hope it is quite clear. Now again I will repeat that whatever the profit before providing for manager's commission should be multiplied by rate of commission divided by 100 plus rate of commission. And it simply means that we have to divide the profit before providing for manager's commission into two parts. One, whatever the percentage, that part, and the other 100 for net profit after providing for manager's commission. Implied adjustments. Now what are implied adjustments? You know, implied adjustments means that we have to look at the trial balance, and from the information contained there we should be able to make out what adjustments we need to make. For example, if you look at this trial balance, you will find that on the debit side of trial balance, 10% loan to Ram given on 11209, 1 lakh is there. Since it is on the debit side of trial balance, it is an asset of ours. That means we have given loan to Ram and we have given at the rate of 10% on 1/1/2009, assuming this year to be from January to December. That means for the full year, interest is receivable at the rate of 10% and that comes to rupees 10,000. Okay, or sorry, 12,000. And if we look at the credit side of trial balance, where the interest received will be shown, you see 9,000 is given. That means from the 12,000 which was actually receivable, only 9,000 has been received. So this fact we have to bring into books. We shall put an entry for this. What shall be the entry for this? Naturally, you have to create an asset, that is interest receivable. So your entry shall be interest receivable account debit to Ram's loan account. Okay? And because of this, your interest in the profit and loss account will be shown at 12,000. 9,000 which is actually given in trial balance and 3,000 for which you have now made an entry. So this will be shown at 12,000 and in the balance sheet, this 3,000 will be added to Ram's loan account. So there can be implied adjustment for interest taken also. For example, in this trial balance, 12% bank loan of rupees 2 lakh taken on 1709. That means on rupees 2 lakhs at the rate of 12%, for 6 months we have to pay interest, which comes to 12,000. And if we have made the payment, then naturally that payment must appear on the debit side of trial balance. If we look here, there is no trace of that. That means we have not made payment for this 12,000. Now we must create a liability. Okay. So what shall be the entry for this? Bank loan account debit to interest payable. Okay. And because of this, the interest payment being an expense will be shown on the debit side of profit and loss account. Okay. And this being a liability, we have not paid it still. So it will be shown in the balance sheet on the liability side. We will add it to the bank loan. 2 lakh and 12,000 is the interest payment which we have to make, and this net amount is rupees 2 lakh 12,000. Now there could be many other adjustments also which could be implied. For example, in this trial balance, salary is given at rupees 55,000 and it is stated that it is for 11 months. Okay. What does it mean? It means the monthly payment of salary is 5,000. That means for 1 month we have not paid and that amount is 5,000 rupees. And for that, what entry shall be made? Salary account debit to outstanding salary. And in the profit and loss account, salaries will be shown at 60,000, 55 which is already in the trial balance, and 5,000 outstanding salary. 60,000 net figure will be shown, and 5,000 being our liability will be shown in the balance sheet on the liability side. So you have to look at the trial balance for all the adjustments to be made on your own. They are called implied adjustments. Is this clear? Now we will discuss accidental or abnormal losses. Now what are abnormal losses? They may happen because of, say, fire, earthquake or floods, etc. And we may lose our fixed assets or stock. And accounting treatment depends on whether they are insured or uninsured. Let us first talk about our fixed assets, say machinery. If by chance some machinery is lost because of some accident, if it is insured, naturally we have to debit the insurance company because we have to take claim from them. If they have admitted the claim, then insurance company will be debited and the respective asset account will be credited. Okay? And in case it is uninsured, that means it is our loss. And if it is our loss, then profit and loss account will be debited and the respective asset account will be credited. And this loss, profit and loss, will be shown on the debit side of profit and loss account. Okay. Now we talk about loss of stock. If your stock which has been lost due to say theft, fire, etc., then if it is insured, then you have to put this entry, these two entries: loss of stock by fire account, loss by fire account, say 50,000 to trading account. Now you must be wondering why trading account has been credited. You see, you must understand that trading account is meant to know the operational capability of the firm. Now this loss has diminished the gross profit, okay, but its operational ability has not reduced. So to judge the operational capability properly, we have credited the trading account. That means this amount of 50,000 will appear on the credit side of trading account, and gross profit calculated will be as if this loss never happened, okay, and actually this loss will be debited to profit and loss account. So first entry is loss by fire account, debited 50,000 to trading account, right? Now this loss by fire, if has been covered by insurance, and say in this case insurance company has accepted the claim of rupees 40,000, then insurance company will be made our debtor, and insurance company will be debited with 40,000, and 10,000 loss which we have to bear will be debited to profit and loss account, 10,000 to loss by fire, and it will be shown in profit and loss account like this. You see, loss by fire 50,000, okay, and out of this, if the whole loss is ours, for example if it was uninsured, then we would have passed this entry, profit and loss account debited to trading account, because insurance company has not to bear it. So in this case the whole amount of loss would be debited to P&L account. But as we were discussing earlier, if it was insured and insurance company has admitted the claim up to say 40,000, then we have to bear loss only of 10,000. So in this case insurance company will be debited by 40,000, and on the asset side they will be in the balance sheet, they will be shown at 40,000, and our P&L account will be debited only by 10,000 rupees, and our profit will be 2,90,000. I hope it is quite clear. So it all depends on whether insured or uninsured. If it is insured, then insurance company will be made a debtor, and the balance amount which they don't admit will be debited to profit and loss account, as in this case we have debited 10,000 rupees. Okay? I hope I have made all the adjustments very clear, and in case you have any doubts, you can post your doubts on my site, which is www.jbsclasses.in.